Now it's time for the bigger picture. Paul Schatz is with us, President, Chief Investment Officer at Heritage Capital. Thank you for being here. I was saying earlier today that when we look at the options market, we're seeing a lot more traders and options, market makers really betting towards the bullish side versus there was another survey done for individuals who seemed a little more cautious. Where do you stand?
Hi, Nicole. Always good to see you. Happy 2025. So right now, my concern, you're quoting the option numbers. We're not quite back to the giddy, greedy, euphoric stance of the end of 2021, but option traders overall, historically, they're really, really bullish right now. It doesn't mean the market has to dive, plunge, crash, but it usually means when option traders are this bullish for this long, it usually means that gains are given back. It's really difficult to grind through the old highs. And that's where I think we are in the first quarter. I think this is a buy weakness and a sell strength quarter. I think we're going to chop all around. We don't get a lot of follow through on big up days. I think ultimately in the next 4 to 6 months, I think that the S&P will erase its gains for 2025 and it'll end up in some sort of 8 to 11, 8 to 12% decline. That's the one that's the one shot I think you get this year to really buy more comfortably. But until then, it is the epitome of a trader's market.
So what do you think about days when you see a name like Google selling off, or a DeepSeek day, or a tariff day where there's this big sort of set of selling? Do you start shopping?
So there's a lot there to unpack on a day like Google. So remember, you just talked about Amazon and preview their earnings. Amazon's run into earnings. Google ran into those earnings. There's a lot of air beneath those stocks if the earnings aren't perfect. Days like DeepSeek, and listen, the tariff thing is the biggest concern for investors. And I think with tariffs, I'm very surprised that the market hadn't priced in more on the tariff front. But I think this tariff story continues as a theme. Each successive day, week, and month, there'll be less and less impact on the downside when the president announces tariffs. And eventually, at some point when it gets warmer out, and we're not living in heavy coats, I think the market's going to be nonplussed by tariffs. But right now, the markets don't like the tariff news, and I think it's just an excuse by the markets because they're looking for a reason to consolidate, digest, wait for fundamentals to catch up a little bit. But am I buying? I'm only buying. I want to see more than a 2 or 3% decline to really get me to stick my neck out risk-wise. You get towards the 7-8%, I'm all there. And listen, we've got a lot on the table already. It's not like I'm not sitting without risk, but I'm definitely more thoughtful about it. I'm definitely selling into strength and buying into weakness.
Right, understood. I mean, when you also think about what's been going on with the dollar, granted, we've pulled off the highs, but we've had a strong dollar where you've had several companies noting the FX headwinds that they're facing because of the stronger dollar. Sometimes, the stronger dollar can weigh on commodities. Oil's been pulling back. Gold, on the other hand, has been hitting new all-time highs, in fact, crossing 2,900. When you think about commodities, are you seeing opportunity?
So regarding the dollar, it's so funny. In the first quarter of 2008, the dollar was essentially left for dead. Everyone thought it was gone. It was never coming back. And now you're at the opposite end of the spectrum. Dollar's been so strong. It reminds me of the mid-'80s. We weren't globalized like we are now. But remember, the dollar is a relative value vehicle. A dollar's priced against other things like the pound, like the euro, like the yen. So all currencies can't be bad. All can't be good. You mentioned gold. So how is gold hitting highs and the dollar is strong? And that's because look what's happening around the world with Europe, with China. That's why gold has got such a bid. Gold, in terms of other currencies, looks even stronger. So am I looking at, I would not buy gold up here. Absolutely. It's not my philosophy. I'd love to buy it into weakness if we don't get it. I do like energy, even though China's economy is probably in some more difficult shape than people realize, but I do like oil for a trade. I don't think this is the time to close your eyes and buy commodities. Similar to equities, I think it's a trading market right now.
All right, so what are we putting in the portfolio? What works here? In the past, you've picked some winners. What works here for 2025 now?
So, because my philosophy is that the first half of the year is going to be a grinder, it's going to be a tougher market, it's a trader's market, not one where risk is rewarded. I'm looking for lower volatility, perhaps more value-driven investments that are maybe depressed. So we've got Under Armour, the clothing company. Listen, they brought back the old CEO. They've cut the number of products they're selling. Those are really good. They've got a really strong balance sheet, phenomenal free cash flow. Stock got left for dead. Nobody talks about it anymore. That's got, to me, the downside's pretty small. And I think the upside is a double from here for Under Armour. Otis Elevator,
Wow.
also depressed. Earnings are depressed in Otis. It's got exposure to China. Um, the earnings have been mixed, but free cash flow, it's still a machine. They've still got 4% free cash flow, meaning they're generating a ton of cash that the company can use. I think the downside, again, like with Under Armour, is limited, and the upside is probably 25 to 40, 50%. That's an Otis. They have a huge buyback they added to. These are all good things, even if the China story goes to zero for them, which I don't think it will. And my other one was, American Water. I mean, everyone needs water. We all know Americans spend money on their water, and that's not going to stop. It's a good, recession-proof stock, although I don't think we're having recession in the next 6 to 9 months. But it's boring. It's depressed. They have a history of increasing dividends. And the only wild card for me there is, are they going to increase CapEx spending like we heard from Google yesterday, which may hit the stock temporarily? But I think these three are low volatility stocks, limited downside, pretty good upside, and they won't get destroyed if we get a risk off market.
Right, and I'm just looking at Otis. I mean, it's also been beaten down. It's it was 106 and now sitting at 95. I mean, Under Armour, UA. So Otis is OTIS. Under Armour's UAA. That too is well off the highs. So you really are looking for value here when you're talking about this. I mean, this name has been come off $12 and it's at 780 or so. And then for American Waterworks, I don't have that symbol. What's that one? AWW.
AWK.
Oh, AWK.
It looks like
so
it's,
I'm just taking a
110 downside, 175 upside-ish.
Yeah, yeah. So you have a lot of upside potential there too, because these are names that have come off the highs, Paul. So it's interesting. So these are low volume, low, more value rather than growth. And then do you think you might be changing the pattern here in the second half of the year?
I do. Look, I remember last June, July, we got rid of every single semiconductor except for one in our portfolio, sector and individual stock, because they did the opposite. They were cooked to the upside. They had gone as far as they were going to go, price for perfection. I think growth's going to slow in the economy. We're going to have a little bit of a scare. If we get this 8 to 11% pullback in the market, am I going to stick with low volatility, Otis and American Waterworks? Frankly, I'm not. You could accuse me of hiding there, which should be fine. I don't have a problem with that. But yes, if we get some downside, especially on a risk-off market, I will happily, gladly, and excitingly rotate back into some more, go-go names. I don't think I'm being paid for the risk I have to take right now. So I'm playing a little closer to the vest without thinking that we're going down 15 to 25%.
Right.
I don't think that's the case.
And then for the back half, would you look at Mag 7 names? I mean,
we own them now, but our position size is small, and that's the key. We don't have these huge position sizes in these big risk-on names. But if we get that decline, yeah, I'm going back.
Yeah, what about Bitcoin? You're worried about a decline more so than thinking there's some great upside potential, right?
2 years ago, I sat here, and when it was 14,500, I said, I think this is a double or a triple. Risk is low. Nobody wants it. Everyone threw it out. Then it went on this amazing, glorious generational run. I'm not buying it at 95,000 or 105,000. I think it's going to go down between 25 and 50% at some point this year. Would I take it for a trade then? Absolutely. But to me, it's not prudent investing to just hop on board the asset class because it went from 14,500 to over 100,000. I think there are better days coming, and I think late comers in these kind of risk on assets almost always get punished. I don't want to be one of those late comers.
Yeah, you're chasing with FOMO sometimes, and then that brings on stress sometimes and losses. I understand. Paul Schatz, great to see you,
You
President
too,
Chief
as always.
Investment
Thank you.
Officer. Thank you.